Hi, to our Practical Nerds Weekly podcast. I'm Shub, and together with my partner and co host Patric, we normally invest in founders in design, construction, renovation, and logistics technology. Many of our friends in the ecosystem wanted us to start a podcast on the built world, and in return, we decided to honor their request with a show about nothing at all. Hey Patrick, so we are back again after a bit of a break. Although a confession here is the break was not planned or intentional. So there are some unforced errors at my end which forced us into taking this break over here. So
I didn't take you for a huge tennis playing aficionado. That's where unforced errors comes from.
that is true. I mean, frankly, even I don't consider myself much of a tennis fan, but that's what happens when you do these things impromptu and on the go. Suddenly, you recall jargon and terms from sports you no longer follow.
Wow. Okay, so I just looked it up. So you're in London right now. So Wimbledon was 6 weeks ago. So you can't claim that it's currently down to Wimbledon.
That is right.
Okay, got it. Unforced errors it is. Yeah, the unforced error was that you're on the island and the island had pretty shitty data connection.
Yeah, that's right. And we're not talking of some esoteric location here, but that's that's a topic for maybe several other discussions in the future.
Yeah. No, we're literally talking about the island that this week published they want to be the AI leader in Europe in the
Oh,
future.
did they?
Yeah, they
Interesting.
did.
Okay.
Yeah. No, maybe fix the data pipelines first.
Very nice. So after this break, Patrick, what are we talking about?
So you and I have I don't think it's provocative at all. So I'm not going to say provocative thesis. I just think maybe thought-provoking thesis, like triggering thesis, and that is in the venture asset class, we think, among others, there is one fairly predictive indicator of froth in the market. And Shub, what is that predictive indicator?
I mean, I know the answer because we discussed it just moments ago, but that is negative gross margin.
Negative gross margin. Okay, so so for a lot of people, this will be uninteresting. So if you don't want the definition of gross margin, skip forward 2 minutes. But Shub, just so we're all on the same page here, define gross margin.
So gross margin would be revenue minus the variable cost or the direct cost it takes for you to create or produce that revenue.
Yeah.
Importantly, it doesn't cover operating expenses and taxes, but it should cover all the direct costs associated with that revenue or that transaction.
With delivering the revenue, but not with originating the revenue, correct?
In general, yes, although there are some definitions where you may have to include origination costs as well, depending on the business model.
That's perfect. Let's actually go through a couple examples here that we tend to see in, venture land and especially project economy venture land a lot. Maybe there's marketplace gross margin, there's SaaS gross margin, maybe there's outcome as a service gross margin, and then perhaps a few other examples that come to mind.
Yeah. That's right.
What would it be in a marketplace?
In a marketplace, now sometimes different marketplaces also employ a gross margin and a contribution margin. For the sake of this discussion, we'll lump it broadly together and maybe provide a high level explanation. So it would be if you're providing a product, let's again simplify it even further. Let's say it's a product marketplace. So it would be the price at which you sold minus any discounts, rebates, cancellations, etc. And further minus the cost of the goods, the actual cost of procuring those goods, and subtracting further the cost of logistics, any service costs, any other implied costs required to actually make that revenue happen.
Takebacks, quality issues would go in there too.
Correct.
Rebates, discounts.
Yeah, if there are some payment processing fees, you should subtract that as well.
So that would give me a gross margin in a marketplace business. It will vary widely. It will also depend on whether you're the supplier on record or more of less of a managed marketplace, let's say. And so you can see anything between sometimes 1%, which is more of a wholesaler trading type margin, regularly 5 to 8%. And in some cases, we have seen 20 to 30% gross margin. Now, if you're the producer of the material, perhaps briefly going more upstream to the marketplace, let's say you're a cement producer, etc., then it's going to be literally what you sell that for, and the cost of goods sold would be the input cost of producing that material plus the logistics, etc., associated with that.
The power costs, etc.
So then you would end up with like 50, 60% gross margin, perhaps, routinely. Right. What would not go in there would be depreciation of your production facility, for example. Okay, so that's one example. Software as a service gross margin typically is what?
Typically would be your cloud expenses or your cloud hosting expenses. Some companies would subtract, they'll assign certain engineering talent or product talent as being direct. So what they'll do is they will distribute the cost of that talent across the revenue base and determine what is the attributable portion of their cost, which can be deemed direct cost to that revenue. If, for example, there is someone you had to pay a commission or an affiliate commission in order to win a client, right? So that would have to be subtracted as a gross margin. Sometimes you have these strategic partnerships or channel partnerships. You'd have to pay that commission. Maybe some sort of payment or server hosting fees, etc. So that would be subtracted.
Sometimes you would have integration costs with your client. So if I have forward deployed engineers, for example, that would go in there.
Yes. Yeah.
I think gives a fairly good idea. I mean, as you see in these cost items, why SaaS typically would be considered a high gross margin business starting at 80% routinely, good ones having 90%, is because the cost of actually delivering that revenue by definition should be fairly low in comparison.
Correct.
Okay. Outcome as a service could be, for example, engineering services that could be human, but it could also be technologically enhanced, automated, etc. So here I'm selling, let's say, an engineering report to someone, a structural analysis, etc. And if I'm a human business, then the man hours or woman hours that go into producing that would be my cost of delivering that. I probably wouldn't have much more. I mean, I don't necessarily consider telephone costs in there. Nobody would actually do that. Perhaps if I have if it's a longer running project and I have procured a specific software specific to this client and specific to this project, for example, a CDE, a common data environment, that would also go if it's specific to this revenue in here, etc. And so it's a fairly simple model in that sense. In a robotics business, outcome as a service. So here it would be perhaps the man or person hours of the robotics operator that goes in, but only the portion that is allocated to actually delivering. So what you would do is you would literally allocate on a per hour or per day basis the cost of that person that is spent in actually delivering the project, and you would allocate it into that project, which, by the way, in the previous example, you would also do that. Yes. You would do the same with the machine depreciation. So whatever the robot cost you to produce, you would do it in the same way. So you would allocate a portion of the depreciation to that project, because this is how you've now utilized the bot. You might have certain materials that go in. So that's whatever adhesives or water or whatever you need would go in there, and that would then give you your gross. And logistics of transportation of that would also go in there. And so that would go into your gross margin. And then typically, most commonly, you would see below the gross margin items that are not oscillating directly one-to-one correlated with the amount of revenue that you do. So you can still have variable cost below that, but oftentimes these variable costs would be very jump fixed. So let's say a warehouse that you have to serve all of your projects. Do you now allocate the cost of the warehouse to each project? I wouldn't recommend doing that. I think that's a bit of an overkill. So I would rather expect to see that in the contribution margin below. And then further down, you will have fixed costs that basically do not scale with the revenue or scale very insensitively, disproportionately with your revenue. Okay, so that's that. I'll save a bonus question for the end, Shub, is what are the best tricks we have seen to actually make your gross margin look big? and it's truly not. But that's not the topic for today, so we'll take that as a bonus at the end. But so now our thesis is, when someone has a negative gross margin, and we see that repeatedly lumping up in the market, that's an indication of froth. Okay, so before I give the mic back to you, I heard a definition from someone a while ago, which I really liked. I'm going to use my words. I think the person used it slightly, used their own words, but in my words, basically that person said, hey, gross margin is the definition of, does your customer find value in what you're delivering? And contribution margin is, can you distribute your value efficiently? And then EBITDA is, later down the line, can you now build your entire business in a scaled way? So do you actually find scale effects? So gross margin is, in this gentleman's definition, which I 100% agree with, does your customer find value because they want to pay for it?
Nice.
So now with that, tell me, what is negative gross margin then?
So before I go there, I think one way I like to internalize it, to me, gross margin is a reflection of pricing power, and EBITDA or net income margin, eventually long term, is a reflection of whether the business has toll booth like ability in the future. Right? We can pick up on that later if we have time. But okay. So moving on to what negative gross margin means is, for example, if I buy a product for $100 and decide to sell it to you for say $80, Patrick.
Great business for me, bad business for you.
Exactly. So what is quite often now the interesting thing, and I illustrated this example here. Quite often, what the use case that is being encouraged or the emphasis is being laid on is, hey, Patrick is delighted, right, in this whole transaction.
Sure.
And you might very well be, right? You have got a product at a terrific price, which you probably maybe weren't able to get anywhere, or you're just thrilled that you got something for cheap, right? So you are delighted, and quite often the emphasis is played on customer delight, right? But what is not, or the idea is often, hey, don't look there, is in order to make Patrick happy, I actually have lost $20 here, right? I haven't gained anything in doing so, or it's like a complete. It assumes that I have the ability to subsidize your delight.
Yeah, you could have just made me happy with giving me the $20. It would be the exact same effect.
Correct, right? So that's the interesting part. So what you ideally want, so the ideal combination, and I'm not saying this is necessary in order to make a great investment, but the ideal combination is where I can make, using our example, you happy, and I've also made some money in the process.
Yeah, right? That would be the nature of doing business.
Correct. Exactly, which is why a business should exist. Now, what happens is, a lot of times, not a lot of times, but every now and then, we have cases where businesses, the way they're building it, and in some cases, in fact, they have not even started building the business, but the plan that they present for the immediate and near future is, hey, this is how we intend to do it, because this is necessary to either delight customers or capture the market, etc., land and expand, grow. All of these words are used, and therefore this is a necessary aspect of the business, and that's why we are raising money, right? And quite often examples are provided from, they'll say stuff like, hey, look at how e-commerce models have scaled, look at how social media networks have scaled using free or freemium models, etc. And that is what is supposed to give credence to this sort of behavior. So let me pause here. Let me get your reaction to what I just said.
So I think the key message that sticks with me immediately is, if you operate on a negative gross margin, you've just gifted me something. I think that's
Correct.
very, very true. I mean, just to put it in different words, imagine I can go on Amazon and buy a product, but you go for me on Amazon to buy that product, and now you resell it to me the second after you purchased it for 20% discount. What exactly is your value creation? Well, it's not there, right? It's actually value destruction. Going back to the definition that I gave, I literally don't value your value creation unless you give me a discount compared to where I can buy it somewhere else. That is the definition of, you don't have value creation.
Yeah.
So now tell me why it's worth building a business that has no value creation. And the only reason that people will typically say is, well, at scale, I will have stickiness, I will have purchasing power or pricing power. And because of that, all of a sudden, my model will work at scale. A fringe argument that you do here with AI a lot, but less so in other categories because it's not even believable in other categories, is, well, we will become more efficient at scale. Just wait for GPT-6. That will be so energy efficient that the tokens will be much cheaper. Okay. How does that square with the fact that the gross margin covers variable cost but not fixed cost? How can I actually achieve scale? Tell me.
I think the answer to that is it doesn't. That's as simple. That's as simple as that. I'm glad, by the way, you covered it, because so as I mentioned earlier, in my mind, gross margin is a reflection of pricing power, and if part of the my ability, or the entirely my ability to delight you as a customer is you're getting stuff for cheaper, it's perhaps the opposite of, not actually perhaps, it is the opposite of pricing power. It means that the moment I decide to increase my prices, you'll probably go away,
Yeah.
right? Unless there's some other angle, etc., which, at least just by this, it doesn't seem like there's any angle, because you're having to subsidize the purchase in order to delight the customer.
I mean, why would I stay? I mean, is there really a business where someone says, "Hey, I'll give you the first one for negative gross margins, and for that you're locked in with me forever, so that after that I mean, sorry, is that like heroin drug dealer business? Do these exist in honorable businesses? Maybe, but the negative gross margin businesses that have been pitched to me didn't have those characteristics.
That is right. Yeah, that is right. I think, when you put it like that, someone may say, "Hey, are you describing like a razor and blade model, or elevator and services model, etc.?" To the best of my knowledge, those are also not pitched necessarily as negative gross margin businesses. I think they're pitched as low gross margin and high gross margin versions of the business. And just to complete that argument, the low gross margin variant cannot also work in the absence of the high margin variant.
Okay, let me run with that. I think you're introducing a great distinction here. So a world I'm familiar with, and you like as well, is the elevator business. Okay, so elevator is literally two products: one, produce and install; two, maintain. Production and installation. The big four elevator companies literally have zero margin on it, but that is contribution margin, not gross margin, to be fair. So they are not subsidizing the installation to that degree, but they do that because, together with the original installation, they require the customer to also close a maintenance contract, typically for 3 years. And that maintenance contract is highly profitable. So that's why they do that. Basically, you get installed hardware base out there, and then you layer a highly profitable product on top of the hardware base. And so that it's true. That is something that in the printer business you would do the same, right? So if you're Canon or Kyocera or Brother, you're giving away the printers for fairly free. I actually don't know if they are zero gross margin. I would heavily doubt that, but maybe they are. And then in the end, you're making money with the ink, the cartridges, etc. So okay, so fair enough, that exists. But then overall, as a bundle of your business, you're not negative gross margin.
Yes.
So the first time I got infuriated with negative gross margin businesses was the scooter businesses. Lime, Bird. What were some other names that we used to have? Can you even remember?
It's been a while. It's been several years since I used one.
But it's funny because these businesses actually are not that old. They're like 8 years old. So 2017 is maybe when the craze started, and then 18 to 20 was when it peaked. Dude, these were, on a unit economic basis, negative gross margin businesses for a long time. And so it was also negative gross margin businesses because the competition was so insanely high. But also because the business model just... there were so many throwaways of scooters, so many, I had to recover them from this ditch. So actually the whole network management and transportation, recharging of scooters, etc., was so expensive that it was difficult to make it work. So it was not like a car rental type of a model. It was literally you were running a network. You tried to be Uber, but without actually Uber's advantages of outsourcing the capex
Yes.
to a nascent market to be activated. No, you enforce the entire capex, the network operations, the recovery of people threw it away, and you had to charge, so that everything on the network actually was negative gross margin.
Yeah.
Quick commerce, Shub. What about that one? That
Yeah.
was the next one.
Correct. I think, look, there's some companies which perhaps are emerging in some parts of the world, which appear like they're closer to product market fit and going public and so on. But the vast majority of them, Patrick, that we've seen, um, and look, I'm not complaining as a customer because I benefited from all the subsidies and all of that, right? Myself. But the truth is, you're right. When you try to pause and figure out the math of what it would take to own a dense dark store network, to have the excess delivery supply available to make deliveries happen like that.
Yeah, and no basket size limitations, right? So hey, here is a what do you whatever. Hey, here's the pepper,
Mhm.
an item worth $1, and you can have it in 10 minutes.
Yeah. Actually, you know what? I think this is bringing us to the crux of what we started with, as to why, in our opinion, negative gross margin is a early or leading indicator of froth in the market. So go ahead.
Okay, go there, but I want to point out, so the quick commerce thing, even if we now spend less time on it, when did it happen? 2020,
Yes.
2021.
Indeed. So if you are either building a business, or I should say choosing to build a business with negative gross margin, or actively pitching for it to be negative gross margin in the future, and we get those pitches, Patrick, right?
Yep, yep,
It's not as crazy as it sounds, where the founders are clearly choosing for it to be run with negative gross margin
explicitly.
explicitly. It means, by definition, you are assuming that more capital has to come into the business. More, the only way for you to survive and grow is more money has to be put in. So you therefore are presenting an extremely bullish and optimistic view of the market, and in our view excessively optimistic, to the point where clearly froth is baked in. Because by definition, again, if for some reason you're not able to raise money, you die.
So
Sorry,
that's
before you go there, it also introduces another problem. The fact that in order to survive, you need money, it also means there's actually no moat in the business, because the moment someone raises more money than you kind of become obsolete.
that is entirely correct, and all of that is then tied to interest rates
Mm-hmm.
ultimately, because if now the interest rates get hiked, and I can park my investors' money, and so I, being large capital provider, large institutional investor, I can now park my money into higher fixed income, lower risk. I will reallocate money, and that's when actually you see receding capital in some other asset classes like ours, which is an alternative asset class.
Yeah.
It really is. So I want to stick with exactly that, because Shub, now you've given the company perspective, but I'll tell you what, I'm giving you the capital allocator perspective.
Mm-hmm.
So if I'm a capital allocator and I'm giving money to someone, what is the fundamental assumption and the fundamental task I'm allocating? I'm giving you the money saying, all right, you can generate a higher excess return than I can by keeping it. So please absorb my capital, put it into your machine, and make more out of it. Pause here and think about, if you have to, just rewind. That is the whole point of capital allocation. So now, Shub, you tell me, hey, Patrick, you're giving me your capital. I'm going to put it through this machine, and in the end, I have less of yours.
Mm-hmm. Yeah.
Not on a burn basis. That is venture, but there the burn is actually below the gross margin.
Yes.
But no, you're telling me, hey, give me your capital. I have this nice little kitchen machine here. I'm going to put it at the top, and it tears apart your dollar bills, and out comes less of a dollar bill. And then I have all my fixed costs. How the fuck Is that making sense for me as a capital allocator? Well, there's a scenario in which it does. And that is the whole point of the froth in the market thesis.
Yeah.
If I have too much capital lying around and I'm getting paid fat fees for managing the capital and allocating it anywhere, and the more I allocate, the more money I am being entrusted with for which I get fat fees, that's the moment I will allocate it into the stupidest and dumbest engines.
Yes.
And that's exactly why negative gross margin businesses do exist cyclically in our industry, and they serve as a leading indicator for froth.
So I'm glad you said that, because I think someone may hear this and say, "Hey, if all this is true, what you guys are saying, why is it that negative gross margins are still getting funded?" I think the truth is, or I guess the hypothesis there is that eventually when everything is done and dusted at the end of the bloodbath, there'll be one winner standing on top of everyone, which has cornered all the capital, either consolidated or seen through other companies dying, and presumably that company has pricing power.
Yeah.
And it could be argued that some companies eventually after many difficult years fit this description. uh, Perhaps, right? But if you're anyone other in that space, anyone other than that one company standing at the end, if you're either a founder or an investor backing other companies, inherently it's a very, very risky game to be playing, because the outcome is, many aspects of that outcome are not in your control in that game.
Tja. So what is the dumbest negative gross margin business you've been pitched in our space? I'll tell you mine. If you want, I can go first or you go first.
I have a feeling you'll win this one. So maybe let me start, just so that you can have your thunder. Uh,
I don't know.
Look, I think I can't think of something. It's not that dumb on the spectrum. I would say something just product marketplaces where the idea is to give rebates and discounts and systematically sell below retail price.
Land grab.
Yes, do a land grab, and then eventually, at some point, the customer will wake up and say, "Hey, you know what? Now I'm ready to pay a higher price." I think that's the claim.
There's
Because,
literally no technological lock-in in these
because
businesses.
who doesn't love to one day suddenly be surprised and start paying higher prices?
Yes, it's awesome. I mean, there are businesses like that, but they've literally locked in their customers. A seller of building materials, like they have other advantages, but that is not an advantage of that.
Yes.
Yeah, I actually my example was exactly in that space where I had someone that raised 2 successive rounds of what was considered to be signal investors, and he pitched me indeed, "Hey, I'm going to go negative gross margin to land grab," and I told him, "Well, first of all, you're not going to land grab at all for the reasons you just mentioned." I even told him, in fact, you're not gonna even close those customers because the customers in our space are extremely intelligent. They know the prices in the market, and they will actually think that you're not going to be around for the long run. So it's not going to be worth actually developing you as their supplier. So you will limit yourself to emergency purchases, spot purchases, etc. Lo and behold, that is exactly what happened. When did he pitch me? Late 2021.
That is actually a point. Maybe I don't remember if you've covered this in another episode of Practical Nerds, but just to add it here, I think quite often we see folks trying to superimpose playbooks that they think they've picked up from B2C models in either food delivery or mobility or e-commerce, and say, "Yeah, for sure, this will work here in construction or in B2B." I think one very, very important aspect, which I think seems trivial to most outsiders, but which is, I think, important to call out. If you're, say, a customer who's buying groceries or food or ordering a cab, etc., and it increases prices, it doesn't affect, in general, and I'm making a broad statement here, it doesn't affect at an overall level your P&L or your purchasing power to that fundamental degree or to an existential degree. If, for example, your grocery prices or a food order you bought moved a little bit.
A household doesn't have a margin, so
Correct.
it doesn't control margin.
Exactly. But in B2B transactions, or most construction transactions are B2B transactions, and especially in the real world, in the project world, when you're talking about changing prices on a business buyer, you are talking about potentially completely dismantling their P&L and the assumptions they've made on how
Yeah.
their business runs, how they keep supporting their employees, etc. So it is by no means a trivial thing to assume that, hey, if you increase 5% here, 3% there, 10% there, it'll fly. In all likelihood, it'll be very, very stiff resistance, especially if you're tackling not an increase in a software subscription, but an increase in material prices, service prices, which makes up the bulk of their cost items.
Yeah.
Expect heavy resistance, which is why you better have very clear assumptions on why you think you have pricing power before trying any such thing.
So we speak about that a lot in here in Fundamental. It's a key tenet of everything that we're doing. We like it when customers have less options, not more options, because that does come with pricing power. It does typically come with transaction velocity, etc. You having to go negative gross margin is already the indicator that the customer has a lot of options.
Yeah.
So in fact, it signals that you're perhaps in the wrong market in the first place. So that's a whole nother thing. But Shub, come on, we cannot talk about negative gross margins without at least discussing LLMs and AI. Come on. So up until this point, half an hour in, you and I seem to be in agreement that negative gross margins are a dumb way of doing business.
Mm-hmm.
Correct?
Yeah.
With the exception of, okay, I roll out one negative gross margin product in order to layer on top, create an installed base and layer on top a highly, highly profitable gross margin product on top. But overall, in a blended way, I'm still not negative. I'm positive gross margin. So negative gross margin businesses, stupid businesses.
Mm-hmm.
So now we're talking about AI and LLMs. I want to share something with you. So yesterday, I was chatting to Dustin, Edify, and the Bricks and Bytes crew. And so we were discussing this too. Shout out to the Bricks and Bytes gang. And we discussed this phenomenon on the, let's say, edges of the discussion. And get this. So Anthropic, the maker of Claude, currently has, according to latest reports, 4 billion of annualized revenue.
Okay.
And 1.2 billion of that annualized revenue comes from two customers. One is Cursor, the code writing application.
Yes.
And the other one is GitHub Copilot, Microsoft subsidiary, again, code writing application. So far, so good. I mean, I wouldn't call that a lump risk, of course, like if whatever, 80% of your business, actually 75%, 70% of your business is with two clients. Okay, that's not great. But on the other hand, it also allowed you to grow very quickly. Fine. But now switch to the Cursor level. So Cursor, VentureBeat reported these numbers that I just gave you. Cursor, we heard through the grapevine, paid 650 million or pays 650 million per year to Anthropic, which checks out, right? So if 1.2 billion is Cursor plus GitHub, and Cursor is the largest customer, it's believable that 650 million out of those 1.2 are Cursor. Okay. Do you know what Cursor's revenue is?
No, I don't.
Take a guess. Very fast growing. Fantastic business if you look top line.
Yeah. So I think they were recently valued, if I want to say around 20, 30 billion. Obviously, the valuation must be at a crazy multiple. So I'm going to be a bit generous and say 500 million.
Yeah. So 500 million per 500 million per July is the annualized revenue. So just for everyone, annualized revenue is a 12 months forward based on the latest month, right? So it's not like, oh, you have generated 500 million in the last year. It's what, it's basically a forward. So, okay, my forward is 500 and I paid 650 to Anthropic.
Yeah.
Now, how does, just so everyone understands why we're discussing this in a gross margin context. So how does Cursor work? Well, Cursor is not a foundational model. Anthropic has the foundational model. Cursor is a software wrapper around the Anthropic model. So Cursor has built a wonderful interface that software engineers around the globe like to use. It wraps around Anthropic's model. It gives you certain superpowers, how to write code, debug code, etc., in a nice environment, etc. But fundamentally, it's not AI. It uses someone else's AI, okay, etc. So what is now my cost of goods sold as Cursor? Well, it's the token call. It's the API calls, the AI calls, the tokens that I pay to Anthropic to deliver my software experience to my customers. So 500 million revenue, 650 million paid. That's minus 30% gross margin.
That is assuming. Oh yeah, you're right. You're right. Yes.
And that's without, let's say, cloud hosting costs, etc. That's minus 30% gross margin. So tell me something, Shub. Now you're an investor in Cursor, okay? You're a shareholder. And the founder comes to you and says, hey, Shub, I'm growing so insanely fast. I mean, the dumbest meme I saw today was hockey stick growth is over. We're now using, actually, let me give you the exact same. Now we're using golf club growth. Hockey stick is too, yeah, hockey stick is not steep enough. We go golf club. Okay, so now you go golf club growth on revenue, but your gross margin is minus 30%. And now the founder comes to you and says, hey, Shub, we've had an amazing year. We went golf club growth to on our revenue, but I need more money. And you're like, why do you need more money? Do you want to grow faster? Yeah, exactly. And then you look into the numbers and you're like, hey, every dollar that we add in revenue actually loses me $1.30.
Yeah.
Are you going to give them more money?
I mean, look, if the decision was left to me, I would be very nervous. Not just with the new decision, but what's already gone in.
Yeah. But you might have already invested $1 billion. So what's another billion among friends, right?
I suppose.
You're already now stuck with that company. So it's quite likely that you give them another $1 billion. And actually, they will literally make 700 million out of it on the gross margin level.
So now that you mention it, hey, I mean, look, I think we might have touched upon this in more than one episode of Practical Nerds. VCs are also human and have obviously plenty of faults. At that point, if I'm a VC in that position, perhaps I'm thinking, hey, oops, I did this. How embarrassing. Now I better give them more money so that I give myself a shot at fixing this.
And I'm going to post about it. And I'm going to say this is golf club growth. It's absolutely the new standard. It's the fastest to 500 million ARR, or the third fastest to 500 million ARR ever. It's so awesome. And I'm going to ignore the whole gross margin thing. But fundamentally, I'm giving you 1 billion and you're making 700 million out of it on the gross margin level.
Yeah.
Okay. So not on fixed costs. No, you're literally putting it into your kitchen machine and less comes out of it.
Yeah.
Brilliant business, I have to say. So another way to put this is you're scaling yourself into hell.
Yeah.
It doesn't matter. In fact, you should scale less. Yes. Because every additional dollar that you scale will make $0.7 out of it. You know, the Americans call this dollars on the cents on the dollar.
Yes.
That's literally what negative gross margin is.
That is right.
So why the hell does it make sense? Well, we're going to be more efficient. The models are going to be more efficient. Shub, this is the biggest lie that is being told for 3 years.
Yeah.
The models are going to be more powerful on the same kilowatt hour, but nobody will actually accept to use a outdated model from years ago that is maybe whatever, just doing barely a good enough job and then using less power for it. That is not what this industry is producing. This industry is in an arms race of who can actually have more nuclear weapons to point at each other. And there is fundamentally a lack of gross margin in this business. Just look up what I think The Information, by the way, it's a fantastic outlet. It's one of the few journalistic media that I think deserve the name of journalism in the tech world. The Information researched the gross margin of Anthropic. Look that up. And also how, by the way, there's a lot of window dressing. So coming to the bonus topic, Perplexity was also being researched, the gross margin. OpenAI gross margin also being researched. I'm not going to repeat those numbers, but I can tell you, you will find negative gross margins across the world in this space. But hey, let's throw more money at it, right?
Yeah.
That makes sense. If I can absorb a lot of capital and earn fees, and nobody asks me why am I giving money to these kinds of companies. But if I have to make money with performance, hey, I earn on actually making, high performing businesses. It's a little bit more difficult to be convinced.
That is true.
So bonus question, how can I window dress my gross margin?
You report, you take the top line. So, okay, what I mean by top line and bottom line, if you're not familiar, in a P&L, the top line would be your revenue, the bottom line would be your net income after taxes. So you change what the top line is.
Yeah.
Right? So instead of taking what should have been the top line, you take several cuts below, or one or two cuts or more below the revenue, and redefine that as your revenue top line.
Yeah, I recently saw that in a managed marketplace where basically what was actually their revenue was being declared some gross blah 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 something. And then the real gross profit was being declared, oh, now this is our net revenue, and we have 93% on that net revenue because we only have cloud server cost below that. It's yeah, cool, I
That
guess.
is, yeah, that is one of those things. I mean, imagine imagine a managed marketplace where the only direct costs are cloud services.
Another favorite item is to move key parts that are actually contributing to your revenue delivery below the contribution margin. So a popular one is customer service cost in a software model.
Yes.
Is not properly allocated actually, and it's being handled. You can get away with that in like a seed and Series A, not because it's correct, but because it doesn't matter. It doesn't
Yeah.
move the needle at that scale at you're at there, but you won't get away with it at a Series C and sophisticated or more sophisticated investors at that point, because then it actually does move the needle to see that. So yeah, so that's another popular way. But I'm always like, okay, I understand when people have to also storytell, especially when you're desperate for money and you want to keep running. But in the end, really, who you're fooling is yourself, because what you're doing is you're investing your lifetime in this business, and it should be a functioning business. It should be a working business. So
Yes.
even if you raise more money for it, but it's fundamentally not working, the first person you're fooling is yourself, because you want to recommit yourself to this business, which might not be working in the first place.
100%. Yeah.
So clean books, start of everything.
Absolutely.
Yeah. Okay. Did we cover it?
I think so. I think so.
Yeah. Maybe one final remark. Sometimes you might have a short black swan event, and so if temporarily you will have a negative gross margin because there is a major market shock, etc., and you want to keep your customers during that time frame in order not to have to, let's say, cold start again after that. I think that's not what we're talking about, right? So that is
We're talking about a status quo or a steady state description of negative gross margin.
yeah,
Yeah.
yeah. So anytime someone tells us at scale I will be positive gross margin, I have literally never seen it. Have you?
So look, what I don't know is some B2C consumer tech propositions that exist.
Okay, yeah, I'm B2B only. That's
What,
right.
yeah, what they might have looked like. I still find it hard to believe that they've made negative gross margin. It might have been that they turned negative after several deductions. I would like to believe perhaps they were not negative gross margin. I wouldn't be surprised if one or two such exceptions exist, or maybe some exceptions exist, but they probably existed after very long time. And when I say very long time, decade plus of having to make sure they remain the last company standing in that
In
space.
my almost 2 decades of B2B career, I've never seen it.
Yeah, in B2B, I firmly agree with you. Yeah,
Never seen it. So, but hey, the models will just get more efficient.
I'm sure.
Yeah, sure.
Yeah,
Okay, good discussion. Thank you, sir.
absolutely.
Cheers.
Cheers.